Hey guys, this is Nick, and in this video I want to talk about real estate. Now, residential real estate has been going up in areas like Florida, Texas, and more rural kind of areas where people are so-called escaping to or working from home because they don't need to be in the city. But commercial real estate is doing really bad, specifically retail, restaurants, and of course hospitality like hotels. So I'm going to show two examples in this video of hotels that one's closing and one is probably on the verge of closing, and the valuation that it has now will really surprise you. So if you want to know where you could possibly buy a Marriott Hotel for about $30,000 a room, click that like button and watch the rest of this video. So the Roosevelt Hotel in New York, right by Grand Central Station, is shutting down, and oddly enough it was owned by Pakistan International Airlines. So not only is the hotel doing bad, but also Pakistan Airlines is doing bad because they had a crash recently, so they have a lot of losses. So this is not necessarily all the hotel's fault, but still, obviously the hotel's not doing good because they're not even going to try to sell it. They want to turn it into office towers. And here's the website of the Roosevelt Hotel. It's a pretty fancy place. The Roosevelt Hotel was built in 1924 by Niagara Falls businessman Frank Dudley. And speaking of Niagara Falls, in the Amherst area of Buffalo, New York, near Niagara Falls, Marriott tried to sell one of their hotels in an auction, and the best bid they got was only 18% of the appraised value from 2011. So that just goes to show you some of the values of what these hotels are worth if nobody's going to them. So here it says the top bid of 10.5 million, and it wasn't accepted, and it was 82% lower than the value of the hotel in 2011. So this hotel is 356 rooms, and it's a 10-story building, the biggest building in Amherst. So if you divide 10.5 million by 356 rooms, that comes out to $29,500 per room. If I told you I know a place where you can buy a building with multiple units at $29,500 per unit, you would probably think it's in some crackhead neighborhood or some rundown Detroit neighborhood or something like that, not in a tourist destination like right by Niagara Falls and very close to a college, SUNY Buffalo. So that's what's going on here, and this company that owns it owes almost $22 million on this hotel on a $25 million loan it took out 9 years ago. So if they were to sell this thing for $10 million, they would be underwater because they paid $31 million for it back in 2007, and just 4 years later it was appraised at $58 million, and here they are getting the best offer of $10 million. So that's what's going on in some of this commercial real estate, especially hospitality and retail, is if you can't fill these hotels, and the border to Canada is closed, it's probably going to be closed for the rest of the year at least. So if people aren't coming in from Canada, people aren't flying in a lot, and this hotel stays empty, they have no revenue coming in. What's the value of the building? Very little. Anybody who buys it now is taking a gamble that things are going to eventually turn around and they can keep it running until that time. There's no guarantee when that will be. And before the shutdown, the hotel was operating at 66.5% occupancy with a net operating income of $2.5 million. So I don't know what they're making now, but obviously it's a lot lower, and this is the kind of thing that's going to happen is if and when they have to sell and the best buyer is 10 million, well, the bank who has this $22 million owed to them, what's going to happen? They're going to have to eat a lot of this money. and multiply that by multiple hotels and buildings that have retail space and restaurant space in them, and that's a big drain on the banks if these hotels and all these buildings don't get some kind of bailout as well. So that may happen, who knows, but right now it's not, and this is going to work its way through the economy. So don't just look at residential real estate and think everything is going well, because if these hotels aren't being filled, then there's no jobs there, and that trickles down into residential real estate eventually also. And just so you don't think this is some crackhead hotel, look at this. This is it, the Marriott here. 10-story building. It's a pretty nice place. And so you can buy this for $29,500 a unit. You don't even have to renovate anything. So Ben Mala, if you're watching this video, head over to Buffalo. You can get this for under $30,000 a door, and you don't have to do anything except find some customers to fill the rooms. Just to show you some comparables in the area, that Marriott Hotel is about here. Niagara Falls is right here, a short distance away, and here, this blue pin here is this 32-unit apartment building for $3.5 million. That comes out to $109,000 per apartment. So more than 3 times more than what you can buy the Marriott for per room. Well, I mean, you can't technically buy it yet because they haven't accepted that $10.5 million offer, but that is the best offer somebody made, is $29,500 per room, whereas here they're asking $109,000 per unit in just a regular apartment building. And to add insult to injury, like I said, the hotel is here, and here you have an Econo Lodge right here, $2.6 million for 65 rooms. What does that come out to? $40,000 a room for an Econo Lodge, which was previously a Super 8 hotel. So if you don't know, that's a bare bones, bottom of the barrel kind of hotel, and it's still $10,000 more a unit than the best bid that they got for the Marriott Hotel. So this is not over. This is probably just the beginning of this kind of stuff. These hotels cannot hold out forever, and when they're forced to sell, you're going to see that the bidders might be few and far between, and their bids might be a fraction of what they thought their valuation was just a few short years ago. And here's a look at the CMBX 9, the Commercial Mortgage Backed Security 9, which has the most exposure to hospitality. You see that it pretty much had a big dive and had a short bounce, but now it's heading back down, and this is what a lot of people are short if they are still negative and bearish on hospitality and they want a quick way to short that market. They would short this index. So that's just a quick look at some of the commercial real estate market, but when you add in retail, when you add in restaurants, when you add in offices that people aren't going back to because they're working from home and all this stuff, and then you add in the people that have no jobs and are still on unemployment, all of this is like a shot of adrenaline that they're giving everybody to keep them going for a little bit longer. But if the Fed doesn't keep bailing these companies and these people out, that adrenaline is going to wear off eventually, and people are going to run out of money. Businesses are going to run out of money. Hotels are going to run out of money. And then a lot of this stuff is going to get sold very cheaply if they allow it to crash. Personally, I think they're going to try to do everything they can to just keep propping it up until they get the inflation that they want. But in the meantime, there may be some deals on these commercial real estate projects like hotels and retail and stuff like that. But it's not for is not for amateurs. Don't think if you've never been in real estate, you're going to go buy the Marriott Hotel or something like that, because it doesn't really work that way. So look, stay in your lane, stay in your size, and if you see some deals, go for it to try to protect yourself from any inflation that they're going to try to put in the system to keep these things going. If you like this video, leave a comment and subscribe if you haven't done so already. Thanks for watching, guys.